Sky News Business. This is Trading Day, The Close.
Welcome to the program. It is a Friday afternoon. We made it to 4 p.m. here in Sydney. That means the curtains are coming down on this local market. Not quite done, but as we head into the final match out, this is where we sit. What a great finish to the end of the week, up by 0.7% right now, or 42 points. Financials, materials really driving those gains. But you've got to say most sectors are actually tracking in the green. I'm Nadine Blaney, also making news this hour. ASIC will launch a civil action against the ANZ over its handling of a 2015 book bill that has also got at the subject of a cartel case as well. And retail sales and industrial production numbers coming in for China in August, with the read mostly in line with market expectations. Well, you could say that the retail sales read actually beat. So that's some positivity coming from China on a week that trade continued to dominate headlines. European markets are expected to start the session higher. We saw a bit of a calming in emerging market tension through the overnight period. The Turkish Central Bank lifting rates there, and the FTSE 100 to open 19 points higher. Don't forget, we also heard from the ECB. Mario Draghi, well, mostly well received by the market, up by about 35 points for Germany, and the CAC in France is expected to open 15 points higher. So really catching that wave that has spread and consolidated, I should say, across the Asian region, with all major Asian markets trading well into the black today. U.S. E-mini futures are pushing higher, up by about 2 points at this time, so adding to a session. Well, it was a pretty volatile session in the U.S. through the overnight period, really, but all markets there did end in positive territory, so that helped to set our market up for these gains that we see coming through today. And yeah, as I mentioned, I suppose there's a bit of negativity in the A-REIT space, the property space here in Australia, but lots of M&A activity happening in that area of the market as well. All right, in the studio with me today, Lawrence Parker-Brown from KOSEC and Guy Carson from Quick Fox Asset Management. Also joining us, Elio D'Amato, and he is joining us live on the line from Melbourne. So great to have you guys all here with me on this Friday afternoon. Guy, pretty solid session today.
Yeah, in the context of the last few weeks, it probably means we've gone nowhere. We're going down quite regularly.
Yeah, no, it was 10 out of the 11 days.
10 out of 11 days, but there were small falls, and then today we've rebounded back. We've really gone nowhere for the last few weeks. We're in a bit of an information vacuum at the moment. Reporting season's finished here. Reporting season in the US doesn't kick off until sort of early to mid-October. So a lot of focus on the macro headlines, in particular what's happening in China, what's happening with the trade wars, and we've seen a little bit of positivity there, which could potentially lead to a little bit of a rally early next week. Obviously, it can all change with a Donald Trump tweet, but right now a little bit of positivity today, and it could continue if nothing changes.
Yeah, we'll take the positivity, won't we, Elio? I mean, we knew that September could be a bit weak. We know that we're after reporting season. We know that dividends are coming out of the market as well.
Yeah, and obviously with enough reasons to sit on the sidelines, investors may very well be thinking that, you know, it's not necessarily the ideal time to get in the market. But obviously, as you know, time and time again, it continues to prove to us that ultimately there'll always be someone to invest in, and you know, any pullbacks in great quality businesses are just great opportunities to buy more. So, no, look, I tend to agree with Guy. Obviously, with the lack of information, particularly coming from a bottom-up perspective, everyone's sort of fishing around for big macro themes to help them adjust their estimates and forecasts moving forward. To this point, nothing really has changed from what we knew last week or last month, for that matter. And until there's any seismic shift in that regard, you'll probably see it jump around a little bit, but generally in a sideways direction for some time.
Okay. Have you been seeing a lot of opportunities out there in this most recent bout of selling that we've had?
Sure. I think there are, as Elio touched on, great quality businesses. The likes of CSL, people say, oh, I'd like to buy it, and then you get an opportunity below sort of $210 that if you don't have any, or you've got some and you'd like to top up, that's an example. And ResMed, we've had as something that we thought was quite interesting post-reporting season. So there are businesses out there, and I guess it's just a case of being nice and vigilant, and if you can, I suppose you can delegate that to other people to help you remind when stocks are lower than you had your entry price.
ResMed was a good story today, wasn't it? Coming out with one of its improved machines, I suppose, and shares really jumping off the back of that. So has the moment to get into ResMed potentially passed?
Sure. I mean, look, for people watching this show, then I think they come in a broad church of different audience members. If you like to sort of be in a quality business and you feel that it's got a history behind it, I think ResMed is an excellent operation that you could pick up today, and I think, you know, maybe you could be a little bit cuter, but I think we've been advising clients post-report that it's a good place to look if you've never invested before.
Okay. Do you like ResMed, Guy?
Look, we hold a little bit of it. We've held it for a long period of time, held it from sort of $6, $7, so done very well out of it. It's one of our smaller positions now. We've trimmed and taken some off the table. We think the valuation is probably a little bit stretched. In fact, across that whole sort of quality end of the healthcare space, we think CSL, we do still hold a little bit. ResMed, we hold a little bit, and Cochlear, we don't hold. We think that space is very, very stretched relative to their history. Great businesses, but I'm not sure you're going to do particularly well over the sort of the medium term buying at these valuations today.
But, Elio, if you're a holder of ResMed, would you continue to do so? They've released this sleep apnea mask. It's a CPAP, and apparently it's the first minimal contact full face CPAP. And I know somebody who wears one of these, and they actually wake up in the morning with, you know, almost semi-permanent marks on their face. So,
yes.
You know, this is good technology in, you know, hits a rising demographic as well right around the world.
Yeah, very much so, and actually ResMed's also one of our star stocks, as is Fisher & Paykel, funnily enough, and both of them are suing each other, so it just goes to show there's always something to keep you entertained in the market. But specifically in regards to ResMed, yes, obviously there's a very strong global, you know, sort of tailwind here in regards to demands for their products moving forward. Obviously we know the scourge that is obesity, diabetes, and hence the subsequent flow through to sleep apnea, and the demand for ResMed products are going to remain quite solid. So you open up that question there with regards to what would you do if you were a shareholder in ResMed. Well, if you don't like money, you might want to sell it, but otherwise, if you believe in this business and believe in the quality of the company that it is, we're very comfortable continuing to hold it within our growth portfolio and as a star stock, of course.
Yeah, happy holder. That's what we'll call it on this Friday. A little bit of corporate news out there. I did mention off the top, Elio, that it's really the property space that we're seeing a lot of this M&A activity, and Investa has postponed or adjourned, I suppose, it's one of its meetings because it really wants to consider this improved offer that has come from, you know, the competitor to Blackstone, which is a subsidiary of the Canadian Pension Fund. Regardless, what do you make of the offers on the table and the demand for this office fund?
Yeah, who would have thought property running hot in this current environment? And yet we also saw another M&A bit of activity, Property Link going for Centuria, which is actually funny because Centuria made a ditch for Property Link not that long ago. So it's really an interesting space at the moment in regards to REITs. Obviously sold down quite a bit on concerns of the whole bond proxy trade, whereby global rates were rising, so that risk-reward relationship between the two diminishes, hence the sell-off there, and everyone goes to bonds. But obviously what we're seeing is actually an acknowledgement from a lot of these companies that economic conditions here in Australia continue to remain incredibly robust. I mean, if you look at the latest earnings season, we saw that distributions for a lot of these REITs are expected to increase by some 3 to 4%, even 5% over the coming year. Now, that's not everyone getting a rate rise or a rate check. You know, some of these leases are for 5-10 years at a fixed rate. So it just shows you that those that do come up for renewal are definitely charging a pretty penny when it comes to actually being able to lift those rates. So we've got a number of REITs in our Star Income stock portfolio. Unfortunately, we don't have IOF, but that's okay. We've seen the flow-through benefit in the short term, and there could possibly be some more as the market sort of takes this moment whereby a lot of prices have pulled back a bit, yet the underlying thematics around rent rises moving forward looks quite strong, and therefore sees an opportunity there.
But do you have to be very, Guy, selective where you look in this Australian listed property space because of what we know about the housing market, as opposed to the office market that continues to go very strong in, you know, Sydney and Melbourne in particular? Yeah,
I think there's definitely pockets you need to look at in this REIT market right now. In terms of the residential REITs, you'd probably be a bit more cautious, given we know that the residential market is slowing, prices are coming off a little bit. The interesting thing is what's happened in the residential market has actually led to a bit of a squeeze in the office market, because a lot of the office space has actually being converted in central cities into residential space, and particularly in that B-grade office area, there's actually a real lack of space in some of the major cities. So there is the potential for a bit of a rate rise there. The other thing you've got to be careful with, one of the lessons coming out of the GFC a few years ago were, leading into that, the REITs had been really bad with capital management, and their free cash flow have been negative. That had turned around in recent years, and they've been much better capital managers, but we're just starting to see the signs that they're loosening the strings a bit. They're getting a little bit aggressive, and that free cash flow is deteriorating a little bit just to start. Something that may impact 18, 24 months down the track, but just something to keep an eye on.
Mm-hmm. That's an interesting one. So do you hold any of these in your portfolios?
Look, we've had a couple of REITs in the portfolio. We have actually exited them in recent times. One that we did like was Asia Pacific Data Centres, but that's actually in a bit of a takeover war, which has turned very, very ugly. You know, if that takeover was to drop out, that's definitely one we'd re-look at. But at the moment, we don't hold any REITs. But we do like, one thing we do like is different, same thematic as regulated utilities. That's an area that we really
Regulated
like.
Utilities, you said?
Yeah.
Like what?
Spark Infrastructure, 7% yield. Regulated 7% yield, so very, very, very little risk. Sold off because bond rates are going up. Similar thematic to the REITs, and we think that's just a safer place to be at the moment.
I'm curious to get your thoughts, because I guess one of the bigger stories on the corporate front this week was Myer posting its first loss. Analysts were quite kind to it in the preceding session, partly because it was an anticipated loss and it could be on the cusp of a turnaround, if you'd like to believe the new CEO, John King. But when you talk about property, I mean, do you look, considering some of the headwinds facing bricks and mortar retailers, those big department stores in particular, you know, Lawrence, do you look at some of those landlords, those, you know, shopping centre landlords a little bit differently these days?
Indeed, I think there's a lot of different ways to play the REIT space. One REIT that's worth discussing, I think it's done really well, and it's probably a sort of business that you could have confidence moving forward, is Goodman Group work alongside Amazon, particularly in the States and Europe. So there are different ways. If you're sort of concerned, as you say, about bricks and mortar retail, it's a very challenging space with tight margins in general. And as landlords, if you, you know, like the Westfield Group and so forth, if you're getting less tenants and maybe you sort of try and get too many cafes and so forth in and they can't all compete, one way to play the space that you think could be interesting is all of those logistical centres, distribution channels. That's a space where, say, Goodman Group operates, and that's a, you know, potentially a space that could see, you know, earnings growth over the next 4 or 5 years.
You think so, Elio?
Yeah, look, obviously the challenges for retail are well known. I'd just like to break it down to the whole point. If the Lowy family don't want any part of it anymore, then I don't know why necessarily we need to. I mean, there's been this huge disconnect for quite some time in regards to the profits and the like that they'd been generating versus the success of their the retailers that are actually within their properties. And I think, you know, there is the potential, obviously, as Australian consumer, you know, purchasing behaviours change, that could continue to diminish, unfortunately. I mean, Myer now, unfortunately, don't have their property portfolio anymore either. And that was always seen as a bit of a, you know, the sort of line in the sand, as it were. And now they don't have that anymore. And it wasn't surprising to see the price jump because, yeah, obviously the rhetoric was a lot of beatings of chest. But to be honest, I've heard it before, and it'll be proof in the pudding before we would even consider this. But with high financial risk, no, it's not our not anything we're looking at. And that retail space is one you've got to be very careful in.
Okay, today we had a bit of news coming from ASIC just in the past hour and a half or so in regards to ANZ. So it has launched civil penalty proceedings over that institutional share placement that took place back in 2015. The cartel aspect of the case is currently already being looked at by the ACCC. So the corporate regulator is saying that the bank should have informed the market and investors when over $25 million worth of the shares placed were taken up by the joint lead managers. This obviously, you know, goes to the question of confidence in the market and the value of shares. So the bank says, though, that the shares represented less than 1% of total shares issued at the time. It says that it is done all of its action in keeping with standard market practice. So obviously it says that it will dispute the allegations. Guy, it just feels like you don't get a day without getting some sort of bad regulatory news coming out against the banks. I mean, is there anything that would make you move into that space at this stage of the game?
To be honest, no, because this is a bit of noise, I think. You look at what happened to Westpac a few weeks ago. They got the fine for basically bad loans. It was $35 million. And it's just basically a slap on the wrist. The more serious issue with the civil news is out today, but the more serious issue with this is the criminal charges which have already been laid. If they do actually put people in jail and they are successful with criminal charges, that changes the landscape somewhat. But the bigger issue is not regulatory here. Well, it is regulatory. It's a regulatory squeeze on capital, which is impacting our property market, which is going to have negative implications for banks down the road. So I think people really need to start focusing on the property market and what's happening there. And the fact is, are we going to have a soft landing or are we going to have a hard landing? And if we do have that risk of the hard landing, while that risk remains, I find it very hard to buy the banks at these levels.
We are focused on the housing market, I think. I do feel like we talk about it all the time, that and trade. Elio, I mean, do you think that we're cruising for a bruising when it comes to the housing market? Or as we had thought when 2018 started, we're going to be able to negotiate a soft landing? And part and parcel is the fact that the regulators did step in and did try to cool down, really over-exuberant housing market.
Well, Nadine, as you can probably tell, I've done this for more years than I care to remember, and the amount of property bears that I've waved goodbye to along that journey, well, I could really fill up a book. Now, I think it's important to always remember and keep, that pragmatic investor hat on. Our property dynamics are very distinct and very different than what your normal share market or normal macroeconomic behaviours are like. There's a very strong emotional tie. And notwithstanding, of course, that there are some lingering concerns, I think calling a property crash is something you're just going to be waiting forever. What is obviously more important, though, is the health of the Australian consumer. So drawing out a bit of a concern from that whole property theme, it's obviously if interest rates were ever to go up, and we know that the cost of borrowing for the banks has been starting to rise, that's going to flow onto those loan holders. And we know that obviously with property prices quite inflated, with debt to income ratios at record highs, then obviously their propensity and likelihood to go out and spend money in our economy will drop back. So rather than necessarily the property market, I'm not very much worried about that. It'll look after itself, with the exception of a few Chinese that have bought some high-rise buildings, which really, to be honest, doesn't affect us. But I'm more concerned about that flow-on effect to the broader economy and then what it'll do to consumption growth moving forward. But that's a long bow to draw. There's a lot of water to pass under the bridge before there. I hear the concerns of many people when they talk about the property market. But, again, if I let that govern my investment decision making, I would have been out of the market for the last 10 years because we've been having this conversation all the way since then.
Oh, well, the last word on that is going to go to you, Elio. Thank you so much for joining us. Appreciate it. Have a great weekend.
Thank you.
Elio D'Amato there joining us from Lincoln Indicators. As the market comes to an official close, we've got it up by 37 points, or 0.6%, 6,165 for the 200. The All Ords at 6,276. Stay with us on this Friday afternoon. When we return from the break, we will talk about the Lehman collapse 10 years on. What's changed? What's not? Evan Lucas from InvestSmart next.
Finding the right insurance policy means research. Shh. Lots of research. Who's got time for that? That's why Choosie's team of choosers are here to make it easy. Follow us. With one call to Choosie, you get to compare and choose from a whole range of insurance quotes. We'll help you be choosy about life insurance. So if something were to happen, you'd have plans in place to look after your loved ones. We'll help you be choosy about funeral insurance. Then your family will have one less thing to worry about at a difficult time. We'll help you be choosy about income protection insurance. That way, if you get sick or injured and couldn't work, you could still pay the bills. We can also help you be choosy about other types of insurance. And with Choosie, you'll pay the same as if you went direct to the insurer. So call Choosie on 13 65 18 to compare, choose and apply. When it comes to insurance, don't leave it to chance, leave it to Choosie.
It is my belief that in the future, just as we've seen with the introduction of the cervical cancer vaccine, we may have immunotherapy to help prevent skin and other cancers. Make no mistake though, we still need to practice sun safety. Children in particular are too young to understand the long-term harm caused by UV radiation. They're too young to know that being sunburnt as a child increases their risk of skin cancer when they're older. But you're not. 2 out of 3 Australians will be diagnosed with skin cancer in their lifetime. Text KIT to 0427 831 112 to receive your free UV protection kit from the PA Hospital's incredible research facility for skin cancer prevention and treatment. Each kit contains 4 days' worth of sunscreen reminder stickers. The sticker changes colour when UV protection wears off. We must help our kids understand the harmful effects of invisible UV rays before it's too late.
My name is Ray, 40, divorced, got a kid.
Hey.
Work security.
Do you think that you've got an anger problem?
No.
Mr. In Between begins Monday, October 1 on Showcase.
Yeah, I know why we're here. Save the dinosaurs from an island that's about to explode. What could go wrong?
What is that thing? They made it.
These creatures don't need our protection. They need our absence.
You gotta be kidding me.
We've entered a new era. Welcome to Jurassic World.
Jurassic World Fallen Kingdom. Available September 26 in Foxtel Store.
Friday, here's where we finished up. We finished up in the green, about 0.6% for both of the major markets here in Australia. A pretty picture to end what was a pretty bumpy week. My guest host in studio, Lawrence Parker-Brown from KOSEC, Guy Carson from Quick Brown Fox Asset Management. Let's get across some of the broader issues at play today. And Evan Lucas, Chief Market Strategist at InvestSmart, joins us live from our studios in Melbourne. Welcome, Evan. Great to see you there. One thing we didn't touch upon in the previous segment was this China data that came out. So a bit of a mixed bag, because while we did see retail sales recovering slightly, investment slowed to a record low. So since records, I believe, were kept at the early 90s, 1991.
1992,
put it in perspective for us.
Yeah, and the other part that I had to look at was what was going on in industrial production, and that was also really, really soft. So it came in the lowest level we've seen since September 2015. Now, that figure alone was actually the lowest read that we'd seen since back at the same time, the 1992 level. So it's back at, the argument is it's 25-year lows. It's basically since records kept going. Now, there is two ways to look at that. One argument would be that you are seeing and have been seeing the impact of the US-China trade war coming through. That's part. I'm more of the belief that the Chinese themselves are currently doing this. They are changing quite dramatically the way that they are looking at their overall financial stability. So for those of you that haven't been watching what's going on in the reserve requirement ratio, what they're trying to do to reduce the amount of debt in their overall market is to basically make banks reduce their savings rates at their point. It's now currently sitting at 15.2, it was as high as 17%, and then using that money to actually pay out the debt that state-owned enterprises use. Now, it works in some respects, this debt-to-equity swap. It does distribute the risk around the market, but it does also mean that return on equity and return on asset value in China is pretty poor. So part of the explanation can be that side. It does hit fixed asset investment because it does slow down overall investment, and it does also slow down output as firms start to sort of more look at themselves on the balance sheet side rather than doing what they have in the past, which is basically powering ahead with expansion almost to sort of no avail. So there's two sides to it, and I think it's fair to say that China will continue to do this. They do need to and are looking very heavily at how they look at financial stability for the next 10 years, not just in the next 6 months or 12 months. It's how they look going forward.
Okay, so you feel quite confident then going forward in their ability to do so?
That's a great question. The Chinese conundrum is always there, and how they go about funding themselves is very different to what we in the Western world would look at and would see as possibly, correct economics. The Chinese have shown time and time again, however, that they can control their overall economy incredibly well and do it very, very well. So I'm confident in that respect. They therefore can and do look internally. They can get their own people and their own markets to support themselves. They do have a population of 1.3 billion people, as we're well aware. what you need to look at is their GDP mix is switching, which I think is also the positive behind it. So they are no longer reliant on basically what is considered private investment, but it's probably more public investment, propping up GDP. It's coming through on the consumer side. So consumption is slowly but surely taking over as the bigger contributor to GDP. So they can keep their middle class is growing very, very rapidly. We know that as well. So there are positives, and bringing it back to an Australian-centric point of view is you can see that the drive for Australian products is still there. I think the one to look at is, if you want to get even more granular, look at the reaction that happened to Treasury wine estates this year, and the demand for Australian wine was well and truly driven by the Chinese consumer, and part of the reason why they had such a good result was the actual Asian figures, and mainly down to China. So there are positives to it. It's whether or not we can switch towards their consumption service side rather than what we have in the past, which is their production manufacturing side.
Evan, Guy Carson here. I just wanted to ask, in the past, when we've seen China slow a little bit and this fixed asset investment slow a little bit, what we've seen after that is fiscal stimulus. Last time we saw it was back in 2015. Now we're starting to see the end of that fiscal stimulus wear off. Are we going to see further fiscal stimulus down the road if this goes too far? Do you expect that over the course later this year or early next year?
Yeah, you do. Yeah, let's be honest, Guy, you do, because the Chinese central government has a controlling mechanism that needs to keep certain things moving in certain directions. So the way you look at it, or at least what I look at anyway, is you look at the PMIs, you look at particularly the big state-owned enterprise ones, and the subcaptors that you look in there are employment, new orders and new growth. And if they are slowing, they're the levers they pull, because they need employment to be basically full, and they need to continue to power them on. So they have the capacity. The issue has always been, and the question that we're debating right now is the level of debt and that debt-laden issue that China has. So this is where, from our perspective, looking at it on a free market idea, semi-forcing your financial institutions, whether that's a bank or some form of private investor, etc., to form investment conglomerates that then put that money into a state-owned enterprise to pay down debt to take equity. We wouldn't swallow that. Now, that's the difference, is that the Chinese economy does do that and are happy to do it. Now, if you look at their equity market, part of the underperformance in the A50, or look at what's going on in the CSI 300 or Shanghai, is that if you look at the fundamentals, that return on equity is clearly going to be affected by that change, because debt to equity swaps do affect your return on equity movements. Longer term, you can see what they're trying to do. They're distributing the risk of debt around to the whole economy to therefore have the ability to buffer it. Now, whether you agree with that or not, I'm probably with you. I don't necessarily agree with it in terms of how it works, but for the Chinese, it has been a mechanism in the past and it has worked. It's not brilliant, don't get me wrong, but it does take a little bit of that debt sting out.
Okay. That's China, and we're not going to crack that nut completely right now, because I would like to get on to talk about this anniversary of the Lehman Brothers collapse. The question is, how far have we come from then? How much have we recovered? How much have we not? So, you brought in a few charts that we can talk about, Evan. So let's first go to central bank rates and bring this up on screen, because I guess the moral of the story is that once we get it up, I mean, look at where we are to the far left of the screen as to where official interest rates of major central banks stood around the 2008 mark. And then look where they still are now. So, Evan, can you walk us through what we're looking at as far as countries, colors, trends?
Yeah, absolutely. So that chart there, it's really interesting that everybody talks about the fact that equity markets were already in decline. The housing market in the States was already seeing pressure. They were bearing out Bear Stearns, Freddie Mae and Freddie Mac. So they were already there. So the collapse of Lehman's, as you know, I know you guys have been playing it all day and I won't go further, it was the one they just couldn't back up because of what was going on inside the central bank. But the reaction here is also very interesting, is it showed that central banks took the unpopular decision in terms of a political view, but to a view of making sure that liquidity just didn't stop overnight. So that is why interest rates across the globe, and look, the top line is us, that's the RBA, that's that teal line. The one to really concentrate on is the salmon one, which is the Federal Funds Reserve. But you can also see the blue line there, that's the ECB, and the ECB is still stuck at zero. And this is the question that I actually had this morning with, and a bit of debate with Martin Lakos, is that Europe has had these record low, basically hugely accommodative principles since almost the end of the GFC in terms of where it is. Yet the turnaround in Europe has no way near been the same as what you're seeing across the channel. So you can see there also that I've got in there the Bank of England. The Bank of England is now at the same rate that we are and probably likely to start going past it sometime in the future. The Bank of Canada is also back at where it was sort of heading towards back in that day. The Federal Reserve, as we now know, has taken over the RBA as well. But the ECB is the interesting one because they're the ones that actually felt the GFC almost the hardest outside of the US and have yet to really show any signs of being able to get back to it. And so have we. That chart also shows you that as well.
Yeah. Okay, let's look at the World Indices chart. And this is post-Lehman as well. And I think that there'd be a lot of shareholders at home that would just feel depressed once they see the next chart, World Indices, and you see how far we have the Australian market lagging. You know, the recovery that we've seen in the rest of the world. Correct.
And look, realistically, I should probably take away that yellow line. That yellow line there is the NASDAQ, and you can see just how influential... yeah, exactly. How influential that has really been. And it is a substantial outlier, and that needs to be put into sort of case in point. But the other ones to look there are the ones that obviously that were affected the most by the GFC, being the S&P 500 and the Dow, considering they were the epicenter of the whole issue. They're the next two lines that are there. You can actually see that they are the next two returners. Now, the other thing about it is that Lehman collapsed on the 15th of September in 2008. The bottom of the market was March 2009, and that's the interesting thing around all of this is the ability to actually tell clients back then to, you know, look through the actual overarching headline risk and look at the fundamentals. Central banks had taken that action you'd seen from the chart before. QE programs were being enacted in the States and in Europe. There was money there. There was some form of return that was going through to corporates, and corporates were actually showing signs of turning around. It was the ability to actually tell people that this was going to happen and get involved. So unfortunately, this is the most unloved bull market around. It's the longest bull market in history too that we're talking about. The other thing to highlight there is we are the teal line at the very bottom. So we are up just over 41% on a capital basis. The
Thank
caveat
God
to
for
that,
dividends here in Australia, right?
Exactly. The total returns, so I'd love to put the total returns in there. Total returns, if you reinvested everything back on top, you're actually up 110% rather than the 41% the ASX has returned on capital. So you're right, Nadine. Thank God for dividends. The ASX has actually done incredibly well for you.
Good afternoon, Evan. Great analysis. I mean, touching on the ECB, I saw some research on Twitter, not my research, but some very good work, showing that the ECB have around double the ratio of the Fed in terms of the fixed income market over in Europe. Supposing that is eventually going to be phased out, is there a market for anyone else to pick up these bills? Does anyone else want to buy them?
Yeah, good question. And admittedly, I don't. The answer is we don't know. I mean, and the reason you say that is that it's clearly there. I mean, the other thing about what's happened and what you're alluding to with their fixed income market is nobody's really wanted it either. So even with the ECB providing all of these different fixed income products over that last 10 years, Litro or what have you, they haven't really been loved because, again, the difference between what happened in the States and happened in Europe is that the States actually lapped up that fixed income market. They lapped up the capital was going there. They were happy to borrow. They were seeing it as an opportunity rather than a risk. Whereas the Europeans went the other way, and the central bank lent out these fixed interests. Corporate banks picked them up, but weren't actually being able to lend that through because corporate borrowing was basically non-existent and still is very sluggish, and consumer lending was basically non-existent and still is. So that's the difference. Is picking up that market is. The reason it's hard to sort of justify who it would be is the return on it isn't there, and the market has shown time and time again in Europe that the appetite just hasn't been as strong as it should be.
Okay, so what have we learned post-Lehman? Let's sum this up, Evan.
Yeah, and the learning curve from it is that the transparency's gone up. That's clear. Regulation has gone up as well. That is also a very good point. The one thing that also necessarily hasn't been learnt is bank lending. So what we've just been talking about, what Lawrence and I were just saying, although bank lending in Europe hasn't been fantastic, bank lending in the rest of the world has been pretty steady and pretty solid in its return. So let's look in Australia. Although we did see a decline, it didn't go into negative territory in terms of growth like it did in the States or some other parts of the world. And the growth in lending since 2013 has actually now put us at levels that we haven't seen ever in terms of the amount of level of debt collection that we have in this country. So that's the other interesting part. The regulation and the transparency has also seen a rise of shadow banking, and that is very, very opaque. And this is the other catch, is that there is certainly parts of the market, particularly personal lending and small lending, so loans under 20K, that are opaque, that have the bigger potential to create risk on an individual level rather than probably what happened in the GFC. And that is where we haven't learnt, and that unfortunately is I think what we're seeing in the Banking Royal Commission at the moment and also across the world, that shadow banking is the risk that could cause another similar scenario, not saying a GFC, but when the next event happens, it will come, and that's the area I think we'll probably pick up on.
I think we'll do a little further investigation on that at a later date. Evan, thank you for your time today. Always appreciate it. Have a great weekend.
Thanks. You too. Thank you, guys.
Coming up, we'll put trade tensions in the crosshairs. Really was a headline driver of markets this week. We've got the airport economist, Tim Harcourt, flying in for his take. Back in a moment.
It is my belief that in the future, just as we've seen with the introduction of the cervical cancer vaccine, we may have immunotherapy to help prevent skin and other cancers. Make no mistake though, we still need to practice sun safety. Children in particular are too young to understand the long-term harm caused by UV radiation. They're too young to know that being sunburnt as a child increases their risk of skin cancer when they're older. But you're not. 2 out of 3 Australians will be diagnosed with skin cancer in their lifetime. Text KIT to 0427 831 112 to receive your free UV protection kit from the PA Hospital's incredible research facility for skin cancer prevention and treatment. Each kit contains 4 days' worth of sunscreen reminder stickers. The sticker changes colour when UV protection wears off. We must help our kids understand the harmful effects of invisible UV rays before it's too late.
Looking for something different? I have the perfect place in mind. This is your family home. Don't give up. This could be yours. Your dream home is waiting. Go on, take a chance. I can give you the home you've always wanted. Everything you need is already here. Your dream, your home, your choice.
It's the season you've been waiting for. New Love It or Listed Australia starts Wednesday, September 26 on Lifestyle.
Fox Flicks. It's all you can watch movies. Oh my God! With over 1,000 movies. And a new movie every day.
Showtime!
Stream as many as you want, whenever you want, at no extra charge with the Movies page. Yes! Fox Flicks, the home of the Hollywood blockbusters. To get Fox Flicks, upgrade to IQ3 or IQ4 now.
Want to watch Foxtel? Wherever you want. Download the new Foxtel Go app, sign in, and you're away. Register multiple devices, watch 2 at the same time, now in HD. Choose between live TV and Foxtel On Demand. Create your own watch list to stream movies, drama, sport and more. And if you have multi-room, you can cast from a device to the big screen.
Foxtel Go. It's just one way we're bringing more to your Foxtel subscription. Wow.
Sean, Pat, Nathan, you're on my team. Gary!
Morning, everyone. Welcome to Fox Cricket. Gilly?
A pleasure to be here. Flats it is.
We'll have a bat.
Cummins steams in.
Miko's gone. Oh, it's gone miles.
Hooray!
Pez is coming around and she's
Unbelievable! Is Perry Billy colliding with a massive esky?
This is cricket like never before.
Now, back live with Trading Day, The Close.
Welcome back to the program. This is The Close on this Friday afternoon. It's great to have you here with us. Us being myself, Nadine Blaney. Also, we've got Guy Carson and Lawrence Parker Brown in studio with me. So, guys, let's find out how these sectors finished up to end the week. And the banks, the big 4 banks today coming to the party, but it has been a very rough go for these ones. The financials as well. We saw AMP, I think yesterday it was, hitting a fresh 15-year low. I mean, you've got to stay away from AMP, wouldn't you say, Guy?
Absolutely. I mean, there's no way regulatory, in a regulatory sense, you know how this is going to finish up. The reality is this company has so many issues they've got to work through, particularly on the advice side, but they've also got the balance sheet of the bank. that you don't know what it's going to look like in 5 years, and therefore it's just very hard to invest on a long or medium to long-term basis.
Yeah, the insurers have come under a bit of pressure on a number of fronts, and that is because of the Royal Commission that is ongoing into the insurers in Melbourne, but also you have to look at the weather, the North American hurricane season when it comes to the likes of QBE as well in particular. Materials, Lawrence, we'll talk about this a little bit more in just a few minutes, but they've seen a bit of a boost to end the week, and that's because we've had a little bit of calming and rhetoric around the trade war between the US and China.
I mean, traditionally, in this sort of stage of a bull market in the global environment, you would imagine that starting the year, materials and energy would both do quite well. I think that there are good reasons to be cautious right now, but I think if you're patient and if you sort of identify particular plays that you'd like to be in, I think the materials space is potentially a good sort of next 6-month play.
All right, oil looks pretty good for the energy plays here in Australia today. Health guy, I mean, CSL went ex-dividend earlier in the week, but that's continuing to be a theme, just seeing this buying. And as we mentioned earlier, ResMed actually hitting a record high today after releasing one of its a refreshed sleep apnea device, excuse the pun, I suppose, in the United States. Telcos, not such a great week for, the Telstras and the TPGs overall, but there's one of your favorite plays, Spark, getting sold off a little bit today, down by about 2 cents or 0.5%.
Wrong Spark. I like Spark
Infrastructure. Apologies.
Yeah, the telco sector's been interesting, actually. You're just starting to see a little bit of love come back in there the last few weeks, particularly in TPG. Very much changing dynamics with the TPG Vodafone merger. I think that's quite positive for TPG. I'm not sure it's actually that positive for Telstra, but you got some bargain hunters in there thinking that it's bottomed. Yeah,
and Telstra was out talking up its 5G capabilities early to start the week. Let's flip the page, get through some of the retailers. So Myer still getting a bit of a boost today in the wake of that result. I mean, it was sold down heavily the day of, but yeah, in the 2 days post, we've seen some buying, but some say uninvestable. You?
Yeah, look, it's so badly beaten up. I guess a bit of refreshing honesty was sort of well received by the market. Yeah, you could well imagine that Myer won't exist in its current form in a few years' time.
Yeah. All right, Infotech. So we had some of those really high PE stocks being sold off. Not so today. We've seen a lot of buying in these names, and that includes those not listed on this page, the likes of Afterpay. Afterpay today up by 4%, $17.27. All right, joining me in the studio, as I said, Lawrence Parker-Brown from KOSEC, Guy Carson, Quick Brown Fox Asset Management. But really, the main theme for global markets has been Trump's trade war with China. It's continuing with Treasury Secretary Tim Mnuchin signaling a breakthrough. Joining us now, Sky News trade expert Tim Harcourt. He's from the University of New South Wales, Sydney, and, of course, the host of The Airport Economist right here.
Great to be with you.
Yeah, it's like a homecoming.
It is great. Home tarmac.
It's a little bit confusing, though, I got to say, when it comes to this trade, because you've got, calming in the tensions with Mnuchin, then you have Trump last night tweeting, and being pretty, aggressive again when it comes to the likelihood of seeing any sort of a resolution.
You think you're confused. Imagine being the Treasury Secretary.
Yeah, right.
Where you just think you've got a deal going and Trump tweets overnight. And I think Trump's wanting to spin it out for the midterms because it's good for him to beat up China. It's really good electorally, even though it's very unstable for the rest of us. So I think he's trying to keep it going.
Yeah. All right. Well, I guess we're going to see no quick resolution. Donald Trump said the Wall Street Journal has it wrong. We're under no pressure to make a deal with China. They're under pressure to make a deal with us. Our markets are surging. Theirs are collapsing. He's still using the markets as, his report card when it comes to his presidency. We'll soon be taking in billions in tariffs and making products at home. If we meet, we meet. Question mark. Not sure what that means. But, yeah, I guess the overarching theme, gentlemen, from a market's perspective is that on any tweet, on any headline, we're going to see this reaction, particularly when it comes to materials that impact our market the most.
Absolutely, and there's a good saying with Donald Trump, you've got to take him seriously, but not literally. So he's got a point to what he's doing. He's trying to do something, but don't take every single word he says literally. And I think the market's starting to maybe look through some of the bravado, some of the tweets, because he always comes in here and he ends up going down to here. So he's trying to cause trouble, he's trying to get publicity, he's trying to help his midterm elections, as you say. But at the end of the day, I think he's sensible enough, well, I hope he's sensible enough, I'm not sure if he is, to not do anything that will actually harm the global economy and, as a result, harm the American economy.
What's interesting, isn't it? I mean, it makes you wonder to what extent the Europeans and the rest of the world economies are letting Trump beat up China. To the extent that the rest of the G7, they want market access, they want things done about non-tariff barriers in China, they want things done about intellectual property. And it's quite handy to have this really aggressive guy in the White House taking on China for you, and they'll just sit back and let him tweet away and see if there's any movement. But I think you're right. I mean, don't take it literally, but do pay attention to it.
Let's talk some positives when it comes to trade, because there is momentum on other fronts, particularly here when it comes to the Trans-Pacific Partnership. So
sure.
What's the latest status in that?
Well, Simon Birmingham's the new Trade Minister, and on this program, Nadine, we said that education and skills was a good background for being Trade Minister, and Jason Clare has said the Labor Party will support TPP with some amendments. So I think...
Sorry, did you say bipartisan support for something?
Yeah. Oh, yeah, in Australia. Yeah. Oh, it's policy I'm talking about, not personality. Sorry. But, I mean, if you read some of the statements of Jason Clare, a shortened government, which is, quite a big possibility now, will obviously run a pretty conventional approach to trade policy, albeit they won't, do an Andrew Robb trick of bringing in labour market testing and those types of things into trade agreements. But I think they'll support an open economy.
Okay, and we have a Wentworth by-election that is now on, and we now have a Liberal candidate, Dave Sharma. He's actually a former ambassador to Israel. So what do you know about him, his background and his approach?
Well, I think in this by-election it's actually good news if you believe in international trade, internationalism, because Dave Sharma is a former ambassador to Israel, a very well-respected diplomat, and the Labor candidate, Tim Murray, is a former businessman in China who can speak Mandarin, and he's run a commodities business and a business back here. So both the Labor candidate and the Liberal candidate do have a lot of international experience, and it's good to see the Labor Party having someone with some business experience on their ticket as well. So it should be a pretty good by-election, and who knows what Karen Phelps is going to do.
All right, so there's plenty still to discuss on the trade front, apart from what's going on between the US and China. Where are you heading to next, Airport Economist?
I've got Latin America, the Middle East and Europe, and Israel later next year, all on Sky News, of course.
Okay, wonderful. We look forward to it. Tim Harcourt, thank you so much for coming in.
Thank you.
We have to take a very short break. When we return, we will be getting our weekly catch-up with Dr. Shane Oliver, AMP Capital Investors Chief Economist. We'll find out what we need to know about the week to come. Back in a moment.
Some websites require so many steps. Click here, select that. What? I have to sign up? And what's with all these pop-ups? And now they tell me it's fully booked. What a waste of time. All I really want is a good 4-star hotel with Wi-Fi, a spa, and to have Boris with me. Simply go to Trivago and type in what you want. It's that easy. My God. Hotel Trivago.
Hello, I'm Anthony Wong, immediate past president of ACS, and welcome to ACS Industry Insights. Our 10th industry leader is Kumar Parakala, global digital leader at GHD.
So digital transformation of the assets using IoT, data analytics, all these technologies are aimed at enhancing the value of the asset and ensuring that the return on investment from those assets, which is often ranging from multiple billions of dollars, that return on investment continues to happen. The need for upskilling and reskilling of the leaders of the business, the top 2 layers of the organization, plus the board, is greater than ever before in the era of digital transformation. The government needs to set a vision where it wants to take our nation in the next 5 to 10 years. And the business needs to then take that vision and make sure that it is helping that national vision translate into action.
To hear more from this interview and our other industry leaders, head to acs.org.au.
What if I told you I could offer you something that would enable you to walk again? Be upgraded, stronger, faster.
Hello? I am STEM, the system operating your body. Wait, can anybody else hear you?
No. Not man.
Looking for the guys who murdered my wife.
Not machine. Something much more.
Did you see that? I'm a ninja.
Upgrade. Rent it now in Foxtel Store.
Coming up on Sky News Real Estate, buying distressed real estate, how to find motivated vendors and bag a bargain. We'll talk to Dominique Grabisa of DG Institute on how to find these gems. And if you're looking to buy prestige real estate in Queensland, Zoran Solano of Hot Property Buyers Agency has all the inside info on how to nab a fantastic deal. Plus, live auction action from around the country.
Third and final call, all finished. Sold to you, sir. Congratulations.
Welcome back to the program. Great to have you here with us, along with Lawrence Parker-Brown, Guy Carson, and joining the conversation, Dr. Shane Oliver. He is the Chief Economist at AMP Capital, and he joins us for his weekly catch-up. There's a lot on this week. There was a lot on this week. If we talk about the economic data that we got out in the United States, you could say it's a bit of a Goldilocks kind of scenario, can't you?
It certainly is. I mean, if you look at the jobs numbers, obviously there's some more data tonight with retail sales, small business confidence, all very strong. But then when you look at the CPI last night, it actually fell a bit, and the call rate also fell back to 2.2%, which if you translate it to the Fed's preferred measure of inflation, what they call the core private consumption deflator, that implies it's running around 1.9%, which is just below the Fed's target. So, yes, there's that pressure on for the Fed to keep raising interest rates, but they can still remain gradual because they don't have an inflation problem. So they just kept ticking over. Next one late this month, then 3 months later, and then 3 months after that. But there's no sign yet that the Fed needs to or will get aggressive in raising rates.
But the retail sales one is going to be a big one. We are expecting gains for the headline to come through, and that is a good indicator of confidence. And of course, consumers in the US are feeling so confident, more so than we are here.
Oh, certainly a lot more so. Yes, a lot more so. Consumer confidence and small business confidence in the US running around about as high as they ever get.
Yeah.
In Australia, the other day when the numbers came out, you know, we're back around the long-term average. So obviously the politics in Canberra are not helping, but it's also against a backdrop of still very low wages growth. So even though the labour market's improved, we're not yet seeing the wages growth. So you can understand why consumers in Australia are not as confident as their American counterparts.
But we have had a pretty good run of data here as well. We had the GDP last week. We had the jobs this week, which, you know, showed underutilization falling. You know, some of those key sort of under the hood kind of measures looking pretty positive as well, minus, I suppose, wage pressure.
That's right, that's right. And the problem is with underutilisation, you're looking at a number there of 13.4%. The equivalent number in the US is 7.4%.
Yeah.
So it's taken them all this time to get down to 7.4%. Now they've got their wages growth up to 2.9%, which is good, but still lowish. And so we're yet to really get it down in a big way. So good news is we need the momentum to keep going, and that will push us in that direction, but we've still got a fair way to go yet before I think the RBA will feel confident.
Is it a case of our economy just being a little bit too uneven, like pockets of strength and other pockets of weaknesses, and the fact that we can't quite get that utilisation rate down, despite the fact last year we had record jobs growth and it's still reasonably solid this year, a little bit lower?
Yeah, I think it is a case of pockets, which is a good thing and a bad thing. When I was younger, you'd have one part of the economy booming and all the other parts would be booming, and then when that one part goes bust, they all go bust together. Whereas in recent times, you've had these divergences across the states, across different sectors. You know, mining goes for a while, then it's housing and so on.
You look at the New South Wales unemployment rate is 4.8%.
It's very low.
And job growth last month was 40,000, whereas something like WA is at 6.2. I think Queensland's above 6 as well.
Yeah.
So you've got this big divergence between states. I mean, how do you fix that? I mean, monetary policy is a blunt tool.
Well, yes, that's true. Then the question is, do you really want to fix it? Because if you do fix it, if you all get them on the same page, then we'll all be booming, and that means much, much higher interest rates. The next thing will be a bust. So in some way, I think what will happen here is the cycle will rotate. The slowdown in the housing market in Sydney, I'm not looking for a crash. I think there's going to be a program on 60 Minutes. Not that I want to do ads out there for competitors.
Yeah, thank you, Shane.
Stick here with the more balanced approach, but I reckon they're going to over-egg it and say we're going to come down 40% or something, which I don't think is going to happen. But I do think there is more downside in house prices. That's going to take some of the heat out of out of Sydney and Melbourne, and you'll see a rebalance to these other parts of the country.
Yeah. I think on Monday you'll be getting a whole bunch of requests from media outlets to come and talk about the housing market. Yeah,
I'm just conscious that I've heard this story before.
Yeah.
There's been numerous scare stories on, I think, 60
We've lived through them as well. When it comes, though, you'll get the numbers. You know, we'll get that ABS data coming out on Tuesday when it comes to house prices. So, you know, the numbers are, though, confirming that there is a slowing happening.
It's not a collapse.
No.
It's going to show something like, I think the consensus is 0.7% decline. We're looking for 0.9% decline. So it's coming down, but it's not crashing. And likewise, when I look at the auction clearance rates every Saturday night, very exciting for me, get the auction clearance rate at 6:30 and do my little chart on it. And it looks like it's sort of bouncing around the lows that we saw back in 2012 and 2008, which are still depressed. It's very low. It's consistent with price declines, but it's not collapsing. It's not going down to 30% clearance rate. So I think that's probably the way we stay, except if the Reserve Bank raises interest rates. Might be a different story then.
So you've got demand just softening a little bit in the residential market. What does that do to the residential construction market?
Well, it slows as well. They're all going to go down together. So that will contribute to that rotation in the economy as housing construction slows down. Probably around the same time as house prices come down, because you've got all that supply will be hitting the market. But I think that probably, again, takes the heat out of New South Wales, Victoria, and then hopefully you'll see a rotation to the other states that have lagged along behind, particularly with mining investment bottoming out. But to me, it all adds up to a story where the Reserve Bank still finds it hard to raise interest rates, because if you've got 40% of the country coming off, New South Wales, Victoria, 40% of the population coming off, it's going to be very hard for them to be jacking up interest rates in that environment.
Well, that's where we'll leave it then. Not much changed on the RBA front this week. Big surprise. All right. Shane Oliver, thank you so much for joining us as always. Have a great weekend. Enjoy those auction clearance rates when they come out. And these two gentlemen are sticking around after the break when we will go through all of the final figures. The market moves today on the final count. That's next.
You're watching Sky News Business, Australia's business channel.
Hello, I'm Anthony Wong, immediate past president of ACS, and welcome to ACS Industry Insights. Our 10th industry leader is Kumar Parakala, global digital leader at GHD.
So digital transformation of the assets using IoT, data analytics, all these technologies are aimed at enhancing the value of the asset and ensuring that the return on investment from those assets, which is often ranging from multiple billions of dollars, that return on investment continues to happen. The need for upskilling and reskilling of the leaders of the business, the top two layers of the organization, plus the board, is greater than ever before in the era of digital transformation. The government needs to set a vision where it wants to take our nation in the next 5 to 10 years. And the business needs to then take that vision and make sure that it is helping that national vision translate into action.
To hear more from this interview and our other industry leaders, head to acs.org.au.
There was a real sense of wonder and fear.
All is not quite right here.
This is unprecedented access.
I'd never seen anything like it. There was a feeling that this was very important.
National Geographic uncovers the truth behind the world's greatest mysteries.
It's a find of a quality that we dream of.
Find out in Lost Treasures, Thursdays at 8:30 on National Geographic and on demand.
We're down to the final 8, and Elvis is still in the building. Avondale out for another big scalp. They face title holders Sydney FC. Then it's City Wanderers. They knocked out the Victory. Now, Giant Killers Apia Leichhardt take on Adelaide, and NPL juggernauts in a tantalising Melbourne derby. The FFA Cup quarterfinals are live on Fox Sports.
My mother was a very secretive and private woman.
She had private rituals, private friends, which maybe explains me.
Sometimes I swear I can feel her in the room. She isn't gone.
The masterpiece that takes horror to a whole new level. Hereditary. Available to rent September 19 in Foxtel store.
Join me for First Edition and AM Agenda every weekday on Sky News. Broadcasting live from here at Parliament House, I ask the questions that are pivotal to the nation's future, going beyond the headlines and often setting the agenda for the rest of the day. I speak to Australia's leaders and hold to account representatives from across the political divide. So make sure you join me for First Edition and AM Agenda on Sky News.
Now on Sky News Business, this is Trading Day, the final count.
Welcome to the final count. Great to be here with you. I'm Nadine Blaney.
And I'm Leo Shanahan.
And we are talking about the market and every move that it made today. Today was a good day, Leo. Look,
Back in the black,
we were
just.
yeah. Well, I mean, that's a pretty decent performance, all things considered. We had a pretty rough go of it. Granted, we are still just sitting at 6,165. But if you look at the high of the day was 61.73. We were as low as 61.28. So yeah, good solid finish.
Yeah, and we see some stabilisation regionally as well in Asia and emerging markets coming back a bit. And we're in the week of the famous point of the GFC, which was the collapse of Lehman Brothers.
I think is the word you're looking for.
And, well, better off than 10 years ago, I suppose.
Yes, certainly so. I just noticed that the composite is now into negative territory, off by about 0.25%. We did have a data release from China today, a bit of a mixed bag being shown there. So we saw on the investment front, record low growth. But growth in industrial output and retail sales recovering slightly. So again, we're just so keyed into China right now.
Yep.
Not only because it's our largest trading partner, we're in the region, but also because of all the fears about a trade war between the US and China.
Yeah, the flip-flopping on trade wars and what's going to happen next.
Oh, yeah. We were just discussing that with Tim Harcourt from the Airport Economist. He's also from the University of New South Wales. So plenty to discuss. Enough of us. Let's get to our guests in studio. We have Guy Carson from Quick Brown Fox Asset Management and Lawrence Parker Brown from KOSEC, also joining us remotely from Melbourne. Great to have her with us. Fiona Clark from Prime Value. Fiona, can you just walk us through what you were watching on the market today, your major theme?
Look, I think that today the major theme for me was that we're continuing to, show this sort of sideways movement, sideways down, and it's good that we had another positive day because, we've had mostly down days over the last couple of weeks. So it was good that, finishing the week on a positive note was also exceptionally attractive. Most sectors were up, a few Wesfarmers and Woolies were a little bit weaker, but it was a good solid day to finish the week on, and I feel quite comfortable about that. Low volumes, though, is an issue, but a nice end to the week, and a nice way to think about the fact that the downside might be limited. There were concerns that this might be a cause for another sort of consolidation. My view is that it's really that post-results season, not necessarily a hangover, but that quiet time that often the market can be a little bit without any drive, and today's move confirmed that this is just that settling in period post-results.
And Guy, like a bit of bargain hunting as well. So if you've had 10 out of 11 days of selling, then you've got people pushing into the market to buy up some of those names that they think are looking value. And could that be the banks as well?
Oh, look, potentially, but you got to remember that the 10 out of 11 days were negative. They were all pretty much small falls. We didn't actually go down that far. I think it was only about 3% and a bit in total. So it wasn't a huge pullback. And never think, markets don't go down in a straight line. They don't go up in a straight line. You're always going to have a reversal every now and then. The banks, they've been bouncing around the same levels, up and down sort of 4 or 5% for really pretty much the whole of the year. I really think the market's still waiting to see what happens with the property market before we actually see a clear trend in these share prices. At the moment, people are reasonably happy to pick up the dividends, which are safe as long as the property market doesn't have a hard landing. If the property does have a hard landing, that's when the risk comes in.
Yeah, one area that hasn't been doing too well is insurance, or at least in a reputational sense, this week in the Royal Commission. We saw, well, the week began, I was down there with Freedom and Clearview being examined over their practices. Fiona, your thoughts on some of this, well, frankly, disgraceful behaviour that was exposed at the Royal Commission this week? And I've been looking at Freedom pretty closely. I mean, can they survive given the basic threats to their business model that ASIC are putting out there?
It's an interesting question. I'm not sure survival in its current form, probably not, in terms of they've already said they're changing the way they're doing businesses and the products that they're going to sell. You know, the broader issue is whether the stuff that they're doing is profitable, and I would question that is actually enough to keep the business going, and that's why they've got this heavy-handed sales technique. To be honest, VEG's the only one that's really actually suffered in terms of share price performance. Most of the other companies have held up pretty well, which I've found quite interesting. But of course, we haven't really gotten to the pointy end of things with them. But can I just say, my big concern about this round of the Royal Commissions, most of the stuff that we've seen before has been about bad behaviour, but apart from things like higher costs that flow through from increased regulation, ultimately, you know, you're still going to borrow money. You're still going to do the things, you know, bank with your bank, get a mortgage. The real risk here is that the repercussions from this side with this bad behaviour that we're seeing is that people actually start to not insure themselves. And we're already an underinsured country. And I think that there's a really huge problem and risk from this side of the Royal Commission that we end up seeing people not taking out life insurance, not taking out trauma insurance, and then being left in dire financial circumstances should anything happen to them.
That being said, that being said, Fiona, I think that the quality of these products is really under question, though, as well. I mean, you've got cover like accidental death, which it was shown pays out so marginally, and ultimately a lot of what was being sold was junk. Not just badly sold, but it was sold. What was being sold as junk. Is it actually a bad thing that we lose these in the market?
No, and I agree with you totally, actually, Leo. Those products shouldn't have been sold, and they shouldn't have been hard sold. But what potentially could happen is that even those good products that have protected people in times of really great need will be tarred with the same brush, and that we might find people in quite risky situations. I mean, as I said, I don't have a problem with these dodgy products and dodgy sales techniques coming under the microscope. I just think we need to keep it into perspective. You know, in the same way that we want strong banks, so let's not get down on the banks too much, because we actually want them to survive. We also want to see Australians have appropriate risk management and wealth management products, including life insurance. So I just, you know...
Yeah. Okay, so that is potentially an unintended consequence, as we say, coming from the Royal Commission into the financial services space, and it will continue next week as well, so we'll continue to see what comes from there. The insurers in general, though, Lawrence, I mean, we see them exposed to, you know, potential tailwinds coming from the bond markets if we see yields rising, but then we've got hurricane seasons happening in North America right now, and, you know, so they're always sort of on the precipice of some major disaster. Do you look at them in the financial services space as a good place to put your money?
No, for those reasons. I think there are, you know, if you're a major financial institution, fair enough, you want to be in potentially different sectors. It depends on your mandate. But for retail investors, as you say, there's so many reasons that an insurer could disappoint you that it doesn't need to be something that, certainly as an organisation, we don't particularly focus on them, because they can do well potentially over a longer term, but they are going to be lumpy because of things outside of their control.
And do you see it any differently than that guy?
Oh, look, I don't think you ignore this sector completely. I mean, Warren Buffett likes insurance companies. He's a pretty smart investor. In Australia, I think the quality name is IAG. It's sold off a bit recently. I think it got too far ahead of itself, and it's de-risked its company by its quota share agreement with Berkshire in recent years. So I think that's your quality name, and if that does start to fall a little bit more, it's one that you potentially look for exposure to. However, having said that, you go back to this Royal Commission, there's a lot of problems here, and a lot of the problems are falling back on the regulator. And the fact is, across all this Royal Commission, we've found out regulators have failed us. There is going to be further regulation in the space, and I think that's a key risk over the years.
Well, one with direct selling, ASIC, for instance, which I actually did a pretty good job in their research and their action against Clearview and Freedom. They got about $1.5 million back for customers. They basically said they're going to ban direct selling. Now, how does someone like Freedom, who's 85% of their business is funeral insurance, they're scrapping these other other types of insurance in direct selling. But if you can't actually direct sell as a direct sales company, you're gone, aren't you?
You don't survive. Yeah. It's very unlikely that you survive this. You know, the shares are at 11 cents as option value. If you are playing the space, stick to the quality end.
All right, let's just move on from that. In fact, Leo, let's take viewers through some of the market moves. In case you're just joining us, let's get up to speed with what happened this session to the performance of the different sectors. And healthcare saw the best gains. We saw good gains coming from CSL. We saw great gains coming from ResMed. Hit a record high today, in fact, on the release of a new product. Infotech also doing well. That good old space up by about 1.3%.
It was a different story for the consumer staples sector, down 0.2% today, or yes, in the end, about 10 points down.
Wesfarmers down by 0.6%. Woolworths, I mean, it traded ex-dividend yesterday, but it was also down today, further 0.3%. Out of the 200, 126 stocks rose, 54 fell. 20 held steady.
And looking at the biggest movers in the market in terms of index weight, CSL led the market higher, up about 7.2 index points. BHP Billiton up 1.63%. Westpac, all the big banks actually not doing too badly, up about 0.69%. Commonwealth Bank 0.32%, and Rio rounding out about 1.2%.
Guys, if you took a snapshot of that page, I mean, those are the names that lift the market. If at an index level, I mean, there's all the big players there. Snapshot.
Coming off a bit of a sell-off too, CSL in recent days.
Yeah, so that's how the market went there. Biggest drag, we mentioned Wesfarmers down. Brambles, though, also weaker, along with Woolworths, Sydney Airport, and Aristocrat Leisure in the bottom movers by index weight. I wouldn't mind touching upon Aristocrat because it has been such a favoured stock by many. But Credit Suisse coming out saying that its foray into digital gaming is not growing as quickly as had been expected. Fiona, do you invest in Aristocrat? Are you familiar with the business?
It's a little bit familiar, but no, we don't follow it. We don't follow any of the gaming and casino.
I mean, it has moved into that digital gaming space, particularly in the US through an acquisition. But I would imagine that its share price reaction is having to do with this note from Credit Suisse.
Absolutely. And look, it's been a tremendous success story in recent years. It's been, and actually go back about 5 years, it was actually a bit of a disaster investment. They've turned the business around significantly. In particular in the US, they've taken significant market share, also here in Australia. But that's in the physical machines. There are huge expectations around what they're going to do in the digital space, and that's why it's trading at a significant multiple at the moment. So if there is a little bit of disappointment in that digital space, that could have quite a big effect on the share price.
And so that's what we saw today. Are you an Aristocrat shareholder?
The organisation loves it as a business, and as Guy's touched upon, it's a business that has great earnings in the US, and the tax environment is quite attractive, and particularly even if you get a little bit of wages growth in the States, it looks like that could be very earnings accretive. Digital gaming is quite an exciting space because it allows them to not just have bricks and mortar machines. So there are broker calls that are around $36 for this stock. If you've been a long-time shareholder, dipping below sort of $29, I don't think it's the biggest end of the world. And I think it's the sort of business that could end up in the top 20 and maybe even the top 10 in Australia over the next 4 or 5 years.
Big call, $28.91 today, down by 0.6%.
Now, more on the banks again. Now, ANZ, the latest to have regulatory action taken against it by ASIC, and this is in relation to that $2.5 billion placement of shares that the ACCC is, of course, taking criminal action against.
The cartel case that we heard about a couple months ago.
This will be civil action about non-disclosure to the market, that there was basically an overhang of that placement. Now, the ANZ ended up higher today, I think. It took a bit of a dip when this was announced from memory, but it didn't. It seems to have taken it in its stride pretty effectively. Fiona, your thoughts on this latest action against ANZ? I mean, is the market kind of just shrugging off the extent and regularity of these kind of events now?
Yes, I do think that that's sort of an element of what's going on, that we've had so much bad news. Could it get any worse? But I do think today's announcement has been interesting, and I'm not sure if it was widely known, but you know, there's sort of reports of the phone calls that have come out, which might have implications for the other case, for the case by the ACCC, where the conference calls between the underwriters and the bank talking about an orderly sale of no more than 5% of the traded companies being sold. That is, you're getting into that sort of manipulation of the market kind of stuff, which wouldn't bode well for the criminal side of things. So I don't think today's news is necessarily positive. How negative it is, really, I think the ACCC case is probably more relevant in terms of the negativity. That's the one with the big fines. And I don't know what the it's a civil case that they haven't actually said what the implications could be. Whereas for the ACCC one, it's certainly $10 million per offence. So it's a much bigger one.
Well, ANZ is saying that it's going to, really defend itself on this matter. It said so as well when the ACCC brought those cartel charges against it. It says that disclosure in relation to the placement was in accordance with its ASX disclosure obligations as well as market practice. And we are defending the matter. So that's coming from ANZ's Chief Risk Officer.
They point out that other banks aren't obliged to inform the market when there's an overhang in a placement like this. Now, you'd have to say, well, what is different about this placement? Is it the extent of the overhang? What is it? Is it this potential combination of criminal cartel conduct that they are expected to inform the market of the overhang?
Mm-hmm. Lawrence, it doesn't bode well in this environment for the banks?
Well, these are material things that are worth talking about, but I think the structural challenges for the banks are so significant over the next decade. They've had a wonderful period of booming in terms of construction and properties. There's oligopolistic behaviour, but I think they're likely to get disrupted. I'm not sure that Australia's going to keep on avoiding recessions for as long as it has done. And the banks, there's regulation which means they're going to have tighter restrictions, not least of all exogenous through Basel and so forth. So I think they're good investments if you're happy with the idea of the dividend, but I think the idea of capital growth for any one of them is probably at the moment a pretty flimsy hypothesis.
Right. Let's talk a little bit about some of the big corporate stories of the week. So we did have the ACCC, speaking of, approving potentially that takeover between CKI and APA pipeline. But of course it does have to still make it through the Foreign Investment Review Board process. And of course, we have an election looming sometime, at least by May. So it's a pretty politically unpalatable deal to get done.
And Scott Morrison, the new Prime Minister, is kind of well known, frankly, for understanding there's not really any votes in China, and is not going. I would, even though it's up to the new Treasurer, obviously, Josh Frydenberg, I think Scott Morrison would take a personal interest in this one.
APA Group, where to from here then?
Yeah, so you got the ACCC approval. I don't see this getting approved either by FIRB, or even if FIRB did approve it, I think the government steps in. This is an asset of national strategic importance. It is pretty much as close to a national pipeline monopoly that we have. Yeah. I can't see it. I can't see it being sold to foreign hands. This company, the Hong Kong company, does own assets in Australia, but they're all over the place and they're bits and pieces. This is a national strategic important, an asset of national strategic importance, and I don't think they're going to allow it.
Are they being unfairly lumped in with a Chinese kind of state-owned company when they are a different beast?
I don't know if they're necessarily being lumped in with that. I just think in this case you don't want an asset of this nature being owned offshore by anyone. And yes, the Chinese and the Hong Kong investment groups are the people with the money right now, and they are looking to invest in jurisdictions like Australia. I don't think we're necessarily discriminating against that one country. We're discriminating against people, companies offshore owning national important assets. Yes.
Fiona, any thoughts on APA? I mean, the share price was down today by 0.2%, $9.65. I guess that's telling us something.
It is telling us something because the offer is at 11, so it's telling us the market doesn't think the FIRB is going to approve it. Having said that, just to take the opposite view, I mean, the other side of the case is that you can argue whether this is a national security issue. I mean, ACCC argued that it wasn't really a competition issue because it was such a highly regulated industry, so competition wasn't so much of an issue. In national security, it's not telecommunications, it's not electricity. You know, there are elements to debate on that I guess the proponents would say it's not such a big deal, but you know, clearly the market is talking and the market is saying that it doesn't expect it to be approved. And as you mentioned, Leo, with an election coming up, I do think that the chances of it going through are probably limited. Let's hope I don't have to correct myself on that later.
Okay, well, time for a quick break, and when we return, we'll put the spotlight on today's top and bottom movers.
As your home connects to the world, our 30 years of digital security experience will help you keep it safe. Introducing Norton Core, the smart, more secure Wi-Fi router for your connected home. Managed right from your smartphone, Norton Core helps protect your connected devices from digital threats and includes parental controls so you can manage your kids' screen time while delivering high-speed Wi-Fi to every corner of your home. Norton Core, available now at Harvey Norman.
Yeah, I know why we're here. Save the dinosaurs from an island that's about to explode. What could go wrong?
What is that thing? They made it.
These creatures don't need our protection. They need our absence.
You gotta be kidding me.
We've entered a new era. Welcome to Jurassic World.
Jurassic World Fallen Kingdom. Available September 26 in Foxtel Store.
What can leave these Hollywood stars speechless? The Emmys are turning 70. So crazy. Tuesday at 10 a.m. Celebrate an epic night of entertainment. That's nice. Hosted by Colin Jost and Michael Che. The Emmy Awards. Tuesday, live from the red carpet at 8 on E. Then the awards live at 10 on Fox 8.
And everyone screaming when the lights come out.
Goodness me. If he doesn't count God, he might just pop.
You wouldn't bet against Patrick Reed following him in.
Don't even act like you know what I'm talking about.
You want to be there for me, or you want to be against me?
I mean, look at that. You never know what's around the corner.
You make a mistake, and you can never take that back.
Let the fist pumping begin.
We're transforming the world.
We got this.
A lot of people have been saying there's no jobs in remote Australia. They're wrong. Here we are at the foothills of Uluru, where a local Aboriginal business is creating jobs and growth. And it's not a mantra, it's a reality. By partnering with a national company, this local Aboriginal business is delivering economic power to the people of Mutijulu. Join me if you want to hear something good.
Mundine means business. Sunday, proudly presented by Westpac. Now, back live with Trading Day, the final count.
Welcome back to the program. It is really great to have you here with us on this Friday as we count down to the start of the Tiki program at 5:30 Eastern Time. Hope you can join us for that. Let's run you through some of the best and worst performers on the day, and I think it will bring us into a conversation about the week that was. So Speedcast, well, that's a toilet seat up and down, but mostly down in the wake of its report a couple of weeks ago. Afterpay. Well, here's another theme from the market this week, Fiona. Maybe we'll start here because we've seen some selling pressure coming through in some of these high-growth, high-PE stocks. But, you know, if they get sold down one day, they're up the next. Afterpay, what do you make of it?
Look, Afterpay came under a bit of pressure last week. A couple of things, not just the weakness in the tech sector in the US, which filtered through to Australia, but also some negative media reports about the way it had treated, from an accounting perspective, some contracts which were loss-making in terms of writing them off in all 1 year, which boosted earnings last year. Today, what we're seeing this week is just a little bit of a bounce from that and an improvement in the sector in general and a focus on the business. Whether or not you can say, you know, it's still value. Is it value? Was it value before? Is it value now?
Yes.
It's expensive, but I think it's more just a correction to that pullback and things getting back on even keel.
Guy, you were talking about another mover in that space and being in a trading halt for 3 days. Why is that relevant at all?
So Access Today, it's a finance company which does equipment finance for small and medium enterprises. And very similar to Afterpay. It markets itself as having a technology advantage. So it could give loans quicker. Instead, our platform allows us to screen the loans more quickly. They could give loans in 15 minutes as opposed to their competitors they could do it in 4 hours. Now that has enabled them to take a significant market share, piece of the market share over the last few years. And this company's only been around for sort of 5 years, similar to Afterpay. That's around the same time frame. Now, this company's gone to trading halt after a big spike in arrears in its annual report a few weeks ago, and the CEO and CFO have left. So something appears to, we don't know yet, it's still in trading halt, it's in voluntary suspension today, but something appears to have gone wrong. And there's a little bit of a risk when you say we can give credit more quickly. Because are you doing the relevant checks, or are you just giving money to everyone? That's a question.
So in your mind, that's a question that has to be asked in regards to Afterpay as well?
I think so, but I have to also say that I've been wrong on Afterpay for a little while now. It keeps going up, but...
Gosh, that's whatever. It's always the PS to the conversations about Afterpays from everybody, and I'm not judging, it's just a fact.
I just think there's a huge regulatory blind spot with these guys that's just waiting to be explored, and you change, you know, 1 or 2 credit provision laws get changed, or ASIC starts looking into it, or there's a few big exposés by the media, and I just think they're so vulnerable.
And it's a big question around Afterpay. Is it a technology company or is it a finance company? And it gets around the loophole. There's a loophole in the laws. It doesn't charge interest. It gives you interest-free credit. So it gets around regulation via that. But then it also makes pretty much all of its profit of late fees, which is really a form of interest if you think about it.
Yeah.
So there's a lot of talk around whether it will be regulated, and that's a big risk within the company.
All right, just a final thought, Fiona. One from you. The week that was, are you feeling good as we head into this US session?
Look, I am feeling good as we go into the US session. The futures are up, I think 40 points, something last time I looked. So I think we'll, unless there's any Trump tweets, I think that we can sort of say that things should be reasonably positive. We'll take it from there.
Yeah, there's always that caveat, isn't there, Lawrence Parker-Brown?
There is indeed, because obviously Trump wants to directly communicate with his, you know, his masses, and I think it's all quite witty as well. I think it gives us a lot to talk about. It moves markets, but obviously there is a broader story, which is he's someone that's atypical in the most recent presidents we've had for the last 20 years. So, you know, exciting times.
There we go. Fiona Clark, Prime Value, thank you so much. Guy Carson, Quick Brown Fox, and Lawrence Parker-Brown from KOSEC. That's it from me.
Thank you, Nadine.
I'll be up next.
Tiki next.